How's it going, everybody? Tristan Powell here. Today in this video, we're going to talk about exchange traded funds, or ETFs. Let's get to it. Keep in mind, I am not a qualified financial advisor, so please go and talk to your advisor before you make any investment decisions. So, exchange traded funds, or ETFs, are traded on stock markets such as the New York Stock Exchange or the Toronto Stock Exchange. Exchange traded funds hold stocks, commodities, and bonds. So, to make this easier, we're going to reference this to food. Like I do with a lot of my other investment things, I make them easier to understand by talking about food, because I love food and I know everyone else loves food too. So, an ETF is a lot like a pizza. So you got your cheese, you got your olives, you got your, what do you call these, pepperonis, and you got your peppers. So let's start with the cheese. So your cheese equals Microsoft. Shares of Microsoft. And your peppers equal Netflix. Shares of Netflix. Your pepperonis are Amazon. And your, last but not least, your olives. Your olives are Facebook. Boom. Olives equal Facebook. You see, these toppings are no longer just toppings. They're part of a pizza. Similar to an ETF, these shares of different corporations are no longer just the shares of Microsoft, Facebook, Amazon, and Netflix. They now belong to one big ETF. So now what happens to the ETF is it gets sliced up. Just like a pizza, it gets put into shares. Now, when someone buys shares of this ETF, they're getting a little piece of Microsoft, Netflix, Amazon, and Facebook. All right, so stay with me. Our ETF follows all four of these companies, not just one of them. So one reason why people like ETFs so much is because, let's say, all our companies are having a good day. They're all green. Our ETF will be mega green. So it'll be big green. You get two green arrows. So when everything's having a good day, our ETF's having a great day. But the same thing applies for the downside. So if they're all having bad days, our ETF is having a really bad day. So it's just one of the risks of having an ETF. But the really cool thing about having an ETF is that, let's say, for example, Facebook is having a good day, Amazon is having a good day, Netflix is having a good day, but Microsoft is having a bad day. Therefore, your ETF will still be having a good day. It'll just be a little one. So the gain won't be as high as them all being green, but you'll still have a green ETF. Another really cool thing about ETFs is they're usually built to track something. So some examples would be some ETFs are built to track the S&P 500. Some are built to track technology stocks. There's actually a cool one that's I forget the ticker symbol right now, but it was built to track space stocks. So we're going to use the example here, HMMJ. It's a Canadian ETF by Horizons Asset Management, and so HMMJ is a ETF that was built to track the cannabis sector here in Canada. So it holds companies like Canopy Growth, Kronos Group, and GW Pharmaceuticals. So when there's broad movement in the cannabis sector, HMMJ is up. And it's good because, let's say Kronos Group, something bad that's specific to Kronos Group happens, that's okay because the rest of the cannabis stocks will keep the ETF up. Keep it green. Get it? Keep it green. So large investment firms make these ETFs. Some of the more popular ETF makers are BlackRock and Vanguard in the USA, and BMO Bank actually is a big ETF maker in Canada. So similar to mutual funds, ETFs also have a manager. If you want to know if you want to know more about mutual funds, watch my video about mutual funds. It should be around here, and I'll also put in the description below. So like mutual funds, ETFs have a manager, and that's where we come into a fork in the road. So when it comes to ETFs, you can either have an actively managed ETF or a passively managed ETF. So to go into basic detail about it, an actively managed ETF is supposed to outperform the market because the manager is hands-on. Supposed to, because it doesn't matter how good you are, you can't expect random events that may happen to your holdings. But these guys are professionals, and it's more than likely that they will outperform the market. They're more expensive. So your actively managed ETF has a higher MER. So MER stands for Management Expense Ratio. The average MER on an actively managed ETF is about 0.75 and up. So for passively managed ETFs, they have the benefit of having a really low management expense ratio. So SPY, SPY, is one of my favorite ETFs. It tracks the S&P 500. It has an expense ratio of 0.09%, so it's almost non-existent. Also, passively managed holdings are going to follow the index, follow whatever's in the holdings no matter what the market does. So in an active managed one, a manager might take some things out and put some things in depending what the market does. In a passively managed one, you're not getting that. You're stuck with what's in there. I think ETFs are great. I actually tried to switch my parents to do ETFs instead of their mutual fund that they use now, which they pay about a 2% a year expense ratio on it. So that nice 0.9 would be really good for them. That's it for this video. I hope you liked it. Thank you for watching. Drop some comments and suggestions for future videos below. I'm still doing stock reviews, so drop your stocks below in the comments and I'll make a video for them. Like and subscribe, and I'll see you in the next video. Good luck investing, everyone. The truth.